Welcome, and thank you for joining us for today's webinar, Tax Implication of MSR Sales and Tax Planning. All participants are joining on mute during this presentation, but during the Q&A session, feel free to unmute yourself to ask questions. You can also submit questions throughout the webinar using the question function on your webinar app dashboard at any time during the presentation. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout this presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will be a survey that appears on your screen at the end of the webinar. Your feedback is important to us, and we want to provide you with as much value as possible through these webinars. If you would take a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richie May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And now I would like to turn it over to today's presenters. Seth?
Hey, good afternoon or good morning if you're on the West Coast. Seth Sprague, Director of Mortgage Consulting here at Richie May. I'm very excited to be joining the tax team here. First time in 2 years at Richie May. I'm actually not really allowed to talk about taxes, but I'm doing a presentation with them. So very excited to talk to you all today about some MSR strategies and with the tax people, and I'll turn it over to Jared to introduce himself.
Yeah, Jared Frost. I lead the mortgage banking tax practice here at the firm. I've been with Richie May for almost 15 years now. It's hard to believe, and it's been a fun ride. So thanks everybody for joining us today. Kenny?
Hi, my name's Kenny Birch. I'm a director in our mortgage banking tax practice. Just had my 10-year anniversary here at Richie May, and would echo what Jared and Seth said. Excited to have everybody on and look forward to talking about some tax planning towards the end of the webinar. So that I'll turn it over to you, Seth, and let you get started.
Great. Well, here's the agenda today. So the first part of this presentation is going to be myself and Jared kind of going back and forth on MSR sales strategies, which I'm allowed to talk about. And then Jared will provide you the tax implications because we all know I'm not really allowed to talk about taxes. And then Kenny's going to wrap us up with, before we get to Q&A, about a bunch of the tax planning just issues that are out there. And so let's get started. Kenny, we go to the next slide. We actually probably skipped 2 slides. And let's just kick it off with kind of MSR sales in general. And this is, we came up with, Jared and I came up with, I think it's 13. Everyone knows I'm not so good with math, which is, it's always ironic to work with the MSR asset and not be good with math. But to come up with about 13 different strategies that we're going to talk through today about the tax implications, and then just so you level set. And I think this is a really good sort of basis for almost every MSR scenario that we could possibly come up with around selling, servicing, EBOs, repurchases, etc. So these are the strategies we're going to talk about. But before we get there, we go to the next slide. I think we have our first poll question of the day. And so we'll pull that up, and I'm going to read you kind of the questions here because we had to kind of truncate things a little bit. So we want you to select the strategy which best describes your strategy. The first one is you originate, sell loans, release to aggregators. The second one, which we've had to, again, a little abbreviate, is we originate, sell to aggregators and the co-issue market. And that could be a PIP market for Ginnie Mae, or it may just be the Fannie Mae market. So the second one is you sell to aggregators and to the co-issue market. The third answer is we originate and retain the vast majority of our servicing. And then the last one is we're not in the origination or the servicing business. And if you answer that one, I'm going to kind of question why you're on the call. You may have dialed into the wrong thing, but that's okay. So we're just looking for the best strategy. And if you sell bulk servicing, we'd probably have you answer 2 here, where you originate and sell to aggregators, co-issue, retain, or bulk if you do bulk servicing. So again, you got to answer all 4 of these CPE questions to get the credit. So we'll give folks another couple seconds here before we launch, and Felicia will let us know when we're getting a decent number of folks responding.
It looks like we need just a few more folks to come in. Hold it open for about 5 more seconds. There we go. Thank you. I will go ahead and close it now and share the results.
All right, so we got people in the middle, which is good. The 2%, I think you might be on the wrong call. You're just here for education purposes, which is great. But we've got a lot of people that obviously are kind of best Xing, right? Originate, sell the aggregators, sell, co-issue. Folks that retain, obviously, if you retain, there's implications for you. And then the first one, obviously, where you just sell and originate to aggregators, that's obviously, there's a lot here for you as well. So with that, we're going to dive right in, and this will be the Jared and Seth show for a little bit here, talking about each one of these strategies. So if we go to the next slide, this is the strategy, and again, I'll kind of rehash the scenarios. You all could read the slides, but this is where, you know, you originate loans, loan on a balance sheet, but there's no MSR created. And so this is much more for banks, obviously, but you own the entire strip of servicing, you've originated that loan, and you actually put it in your portfolio. Vast majority of our IMB clients actually would not really be doing this, but we'll loop back on repurchases. But with Jared, with that, what are the tax implications if I originate something and put it on my balance sheet?
Yeah, so loans are going to be recorded either at fair value, or fair market value, I should say, or at cost. In the typical scenario that Seth was talking about, where you're actually going to portfolio this on your balance sheet and hold it for some extended period of time, it would go on at cost, right? And then there would be no adjustment to that from a tax perspective until you did something else with it, sold it down the road or something like that. You know, in a lot of cases for IMBs, right, when you're putting these things on your balance sheet, your intent is to sell it. So it might be on your balance sheet for some short period of time. And if that's the case, then you're considered a dealer in securities for tax purposes, because you regularly purchase or sell securities in the ordinary course of your trade or business. And so it go on at fair market value, and then just be adjusted accordingly. Obviously, you know, generally you're keeping these things on your balance sheet maybe 30 to 60 days in that scenario. So not much shift in the fair market value during that time. And then you sell it and recognize any gain or loss at that point. But kind of in that scenario that Seth was talking about, it would go on at cost, stay on at cost until there's something else that happened. Could be impaired in that scenario for book purposes. And generally from a tax perspective, we would not recognize those impairments. Again, it would just go on at cost, stay there until you did something else with it. So that's kind of this scenario, which again, mostly banks are doing this, not IMBs. Seth,
and Jared brought up a great point where an IMB would have the loans and a corresponding warehouse liability for a period of time before they sold the loans. But we could move on to the next scenario. And so this is kind of the first one where we had a decent percentage of the folks answering. And so this is where you're selling loan servicing release to the aggregators, right? So you're getting paid for the loan and the servicing release premium, or that SRP. So you're actually getting in cash for 2 items. And not being very good in tax, this always sort of confuses me. But so I'm getting 2 cash in. I'm getting a loan and I'm getting value for servicing. So Jared, as we think about that scenario for folks, and we've got a lot of folks on the call that do this, what are the tax treatments around this type of transaction?
Yeah, so from a tax perspective, it's viewed as though there's no separate asset created, right, to your point, until you actually create the separate asset. So in this scenario, we're not actually creating a separate asset because we're just selling the loan, servicing released. And so, I originated the loan, which created a basis. I recorded that loan at fair market value, again, because in most cases I'm a dealer in securities. So that goes on at fair market value. And then when I later sell that to the aggregator, I'm just going to recognize gain or loss. So in this case, in most cases, you're going to have the same treatment for both book and tax purposes. No real difference there. The only potential difference is if for some reason you valued the loan differently for book and tax purposes, which is rare but not unheard of. And in which case you might have a different basis for tax purposes than you do for books, and therefore when you later sell that to the aggregator, could it result in a different gain or loss being recognized on that. And then I just throw in here that you'd recognize ordinary income on that sale from a tax purposes. Again, because you're a dealer in securities, this is part of your ordinary trader business. No opportunity for capital gains at this point.
And for a lot of people that sell this, they're getting in that kind of one pile of cash. So they're really not differentiating, as I think about it, from an SRP and a loan. They're getting paid sort of that all-in number from the aggregators. But it's nice to know the tax sort of lines up with the cash, obviously, on that. And I'm the servicing guy, so I always want to see what that SRP is, even though
Sure.
it's embedded in that loan price.
Yep.
So this is the next scenario we're going to talk through, and this is, you start to sell loans direct to the agencies, and so we kind of highlight Fannie or Freddie here. Obviously, it could also be co-issue sort of pit with Ginnie Mae. So I just want to make sure we've sort of covered that. But we create a scenario where we sell the cash window. There's 25 basis points of servicing is created, and that servicing is immediately sold. So in this scenario, in my mind, we are keeping that agency relationship. We're actually getting credit with the agencies for delivering the loan. And we are sort of bifurcating that asset at the time of the agency. We're splitting off that servicing and selling that servicing to a co-issue, whether you're using Freddie Mac Co-Issue Express, using Fannie Mae SMP. You are sort of getting now, I think, two sorts of cash flows here. And so I think this one starts to be a little bit more of a nuanced answer from the tax side, but again, I'm not allowed to provide tax advice. So Jared, go ahead.
Yeah, so here, exactly, now we are, because we have separated this asset into two components, right? Now we have a loan and an MSR from a tax perspective as well. But the distinction here is that, in this scenario, at least, we're contemplating a 25 basis point strip. And because that's a 25 basis point strip, it meets the definition of what we refer to in tax lingo as normal servicing. And I've got the safe harbors listed there as to what normal servicing is. So if you're getting on a conventional loan 25 bips, or on a government loan, FHA, VA, guaranteed or insured, 44 bips, or on something else, ARM jumbo, something else, 37.5, you're within what we call the safe harbor rates for tax purposes. And what normal servicing really represents is just compensation for services, right? So they view a portion of what you might get as on an MSR as just compensation for services, and so therefore they don't view that from a tax perspective as creating some separate asset that has an income stream associated with it. They just say that 25 bip servicing fee you're collecting is just for the services that you're providing under the contract. And so we don't create an MSR asset for tax purposes under that scenario. The entire basis is allocated to the loan. And so therefore, when I sell the loan, I'm generating a gain or loss. When the MSR is sold, there's no basis associated with it. So I'm just getting the cash and creating a gain or loss, recognizing a gain or loss. But on both components in this scenario, it's just going to be ordinary income. This is just normal operations of my trader business. I originate loans, I sell loans, it's ordinary income.
And we may circle back at the end a little bit more on safe harbor, given Ginnie Mae 1s and 2s, but we're going to move on to the next scenario here as well. And then this is it's kind of the same relationship where I'm again specifically being very specific about creating that 25 basis point servicing strip, so I stay within the safe harbor. I always picture that fishing show, right, where they're going for crab legs and crab, and they got to go into port because the waves are anyway. So safe harbor. So this is where you're selling loans, the cash window, Fannie or Freddie, creating that 25 strip, and you're keeping the servicing. Where the other scenario was, I was selling it immediately off. So here, again, from my perspective, I'm creating an MSR asset at that time that I have to put on my GAAP financials at fair value, and I'm not getting paid cash. This is a scenario where you're actually deferring cash. And many IMBs out there have done this because deferring that cash sort of creates equity for the company as sort of stored value on the MSRs. So anyway, 25 basis point servicing strip, Fannie and Freddie cash window. What's the tax treatment on this one, Jared?
Yeah, so it's very similar to the last one, again, because we're within the safe harbor rates, right? So even though there is an MSR asset created for GAAP purposes and recorded on the financial statements, from a tax perspective, we are not creating an MSR asset. So again, all the basis in this, in this loan is assigned to the loan. When I go through that bifurcation process of trying to bifurcate my basis between the loan and the MSR, none of it's assigned to the MSR. So when I sell that loan, I have a higher basis for tax purposes. That creates a lower gain or a bigger loss, depending on what you're selling that for. And there's no MSR asset created, again, because I'm within those safe harbor normal servicing rates. So all the fee that I'm collecting is just for a compensation for services.
And this is the classic tax wedge, right, that we talk about when it comes to servicing, right? I create that 25 servicing, I don't pay taxes on it day one, and as I always had to explain to my management team, we pay taxes as we earn the cash of servicing over time, which again is ordinary income. But I can't give tax advice.
That is correct. And then later on, we'll get into the bulk sales scenarios where, because I have no basis or lower basis, I'm going to create a huge gain if I sell these things. So we'll talk about that here in a minute.
Great. We can move on to the next scenario. And by the way, Jared and I were joking before we started the presentation. If we do your taxes and you do all 13 of these transactions, Jared's going to send you a Richie May shirt that we'll all sign, because if you've done all 13 of these, you're running a very complex business, especially when you get to some of the ones at the end. So here, let's talk about Ginnie Mae securities are created and released. And again, we're sort of just, I think the answer here is going to be very similar to our last one, but we did want to just call out the PIT market as separate, because remember, the Ginnie Mae market does have a different servicing strip potentially around it. It's not necessarily a flat 25 at times. And so, here we're selling it via the co-issue market. And so, Jared, I would expect a very similar answer to our co-issue at 25, but there is a little bit nuance there around the potential servicing fee structure under a Ginnie Mae 2 security.
Yeah, so in here, again, with my response down below, I assume that we're getting some sort of safe harbor rate, but you're right, if we don't, and there's a scenario coming up where we don't, and so I'll get into the concept of excess servicing and what that is, but here again, we're just assuming normal servicing, I'm getting, 25 or 44 bips or something in this, and so I'm not creating an MSR asset for tax purposes, I'm just selling the security / loan, however you want to look at it, and creating gain or loss on that sale.
And again, Ginnie Mae is different in terms of Fannie or Freddie from a delivery standpoint. You can deliver cash window Fannie or Freddie. If you have a Ginnie Mae, you're creating those Ginnie Mae securities, which is why getting, and Ginnie Mae gets mad when I say the Ginnie Mae ticket, but the authority to issue Ginnie Mae servicing is something that you have to go through a separate process to go through. It's because you're creating a security at this point. So we go to the next one. And then here we're going with either the MBS security, again, going for not the cash window, but that MBS on the Fannie and Freddie side, or technically the unified mortgage MBS, which we created several years ago in the industry, or Ginnie Mae securities. And again, we're just retaining that servicing, and it's all within those safe harbor limits. So again, kind of a similar type structure to the actual, but we did want to call out the MBS because it sets up our next slide. So Jared, you go ahead and kind of give us the tax side here.
Yeah, so again, we're in the same boat. A lot of repetition here in these early slides. We'll get into some juicy tax stuff here in the next few slides. But again, because we're within those safe harbor rates, it's all normal servicing, not creating a separate asset for tax purposes, just recognizing ordinary income on the sale of that loan, if you will, or security, loan into securitization or on the securitization itself. So pretty straightforward, just like we've talked about the last few slides.
And we could go to the next slide. And then so here where we've got, now we're creating the excess, right? So we've built this up to now we've done base, safe harbor. Now we're not in the safe harbor anymore. We're actually out in the open ocean. So those MBS, UMBS securities are created. In this example, we're creating a 35 basis point servicing strip. And remember, that's that best execution process where you're trying to slot loans into the right security. You could create a larger servicing strip than 25 basis points. And as we know with Ginnie Mae 2 securities, You can create between a 19 and a 69 strip. So again, here we're actually creating what we're going to call as classic excess servicing, right? Something above safe harbor. And so that has its own sort of tax implications, which Jared's going to talk about.
Right, so in this scenario, now we are actually going to create an MSR asset for tax purposes as well, because now we're above those safe harbor rates. And what that is referred to in tax lingo is excess servicing. So if we're above the 25 bips on a conventional loan, if we're above the 44 bips on a Govy loan, and so that's what his two scenarios here are, right? 35 bips or 69. Now we're receiving something in addition to just compensation for services, right? And so that excess strip does create an asset for tax purposes. We're going to recognize gain on, for that proportion of it up front, like they do for GAAP purposes. And because it represents a right to receive, interest payments on this loan, right? So it's something different than just compensation for services. So that is recorded at fair value. We're going to put it on, our tax balance sheet as well, just like we do our GAAP balance sheet, but it's just for that excess portion. So there's got to be some sort of calculation or value assigned that's different than what's assigned for GAAP purposes, because GAAP is doing the entire MSR, right? So, if GAAP puts it on at 100, the excess piece might only be worth 30 or something like that. So for tax purposes, we're putting it on at 30. There's still a $70, difference in that gain that's recognized up front. We get to defer that $70 for tax purposes until, again, we do something with that MSR down the road. That's ordinary income when we recognize that excess servicing up front. And then there's some, complicated rules around how we can amortize that value from a tax perspective. We also often just view this as a security, and since you're a dealer in securities, you're required to mark all your securities to market. If this is a security, that's what we would do here, right? And that's what you're doing on a GAAP basis as well, with both the normal component and the excess component, is you're marking these to market, putting them on at fair value, generally at least. And so we would just follow GAAP treatment, again, with just respect to this excess strip.
And this is an area that some clients, past lives, current lives get tripped up on, right? They're getting an MSR valuation, a fair value valuation on their total servicing portfolio. And then the tax team will come by and go, well, I just need it on the excess piece. I just need it on that 10 basis points, and that 19 basis points. And so it does require a separate, typically, if it's material, it does typically require a separate valuation specifically on just that excess piece, so that the tax side can do on its tax records that fair value adjustment as well. Despite the fact I've argued in past lives with my tax team multiple times, just allocate it, they always want to see that separate valuation.
Ideally, yes, we'd see the separate valuation, and we know that there are valuation companies out there that will provide that separate valuation, and we've certainly seen that with many of our clients. If we can't get that separate valuation, then yeah, we'll just take a simple math approach to it, and what's the total value of that MSR? What's 10 out of the 35, right? Do that math times the value and say, okay, that's our excess servicing. Generally, it gets us pretty close. So
pretty close, and as long as it's not too material, you're not really going to pivot for that excess valuation standalone.
Yep.
All right, we go to the next slide, and here's our second poll question. Just to remind everybody, you got to answer all four of these to get your CPE credit. So approximately what percentage of your company's loan production is sold servicing retained? So again, what are you keeping off of your loan production? So 0, 1 to 25, 26 to 50, 51 to 75, again, 76 to 100. I'm kind of asking for 2023-ish numbers. I realize that for most of the industry, this number probably changed from 2021 levels. It started to change in 2022, and it certainly changed for a lot of clients in 2023. But again, if you're not retaining servicing, a lot of these kind of slides here in the middle of this just aren't as applicable as if you are retaining servicing at some level of servicing or you're doing bulk sales. So with that, Felicia, hopefully I've tap danced around enough that we're getting closer to critical mass. People answer.
It looks like everyone is in. Thank you all. I'll go ahead and close and share the results.
And again, we've got a nice distribution here, right? Where we've got, and full disclosure, across a lot of IMBs, it is a really interesting trend. I'm not surprised to see that 1 to 25%. For some reason, the industry has sort of migrated to this 20 to 25% retain number, whereas in the past, they may have been higher than 50%. But we do have a fair amount of folks that are retaining more than 50% of their servicing. So again, they're deferring that cash, they're creating that tax wedge. They'll have tax implications in the future. You eventually pay taxes on servicing one way or another, but it is a nice tax wedge as long as you're within those safe harbor levels that we keep talking about. So with that, we could go to the next scenario. And here we go. Now we've done something, right? We've retained servicing, and now we're selling bulk servicing, but we've retained it for less than 1 year. Okay, and so again, less than 12 months of payments, and I always get the question, is it 12 payments? Is it 12 dates? I always go 12 payments, but maybe there's a different sort of tax implication here. But again, we're generating, we kept the servicing, deferred the taxes, realized some servicing revenue, and now we're going to sell it in a bulk and get a pile of cash, hopefully. So Jared, do I have to pay taxes? Because I don't like paying taxes.
Yes, so now this is when you do have to pay taxes, right? You know, we've deferred them up until this point, or at least the bulk of them, hopefully, have been deferred up to this point. But now we're going to turn around and sell these. This is when the tax man comes calling, right? So, and it gets a little tricky to kind of Seth's point about when is the 12-month, you know, cutoff or whatever. We've kind of told, you know, our clients, we think it's when that loan is sold, because that's when the MSR assets, you know, really created, right? So when you sell the loan and retain the servicing, now you've actually bifurcated that into 2 assets. You actually have an MSR asset that's sitting on your books. That's the date where we would say start measuring your 12-month period from that point. And so, yeah, the distinction here between this one and our next slide that we'll get to is that 12-month period can be very important from a tax perspective, right? And if you look down below, this is why. So your purchase price, you know, what you're going to receive for these MSRs is bifurcated in up to potentially 3 components. One is what the tax guidance refers to as the compensatory portion. And this is generally sort of analogous to normal servicing, right? It's generally the value associated with the reasonable compensation that you're receiving on these MSRs. And that component gets ordinary treatment because it's kind of part of the ordinary course of your trade or business. You know, as a servicer, you're required to provide these services. There's a value associated with that portion of the strip that you're receiving, although it can be relatively small portion of the value, but that portion is going to get ordinary income treatment. Then you've got what they call the stripped coupon component of the value. And this is really analogous to excess servicing. So if you had excess servicing on this particular MSR that you're now selling, in theory, you have basis, right, associated with that. In theory, you've been recording that, you know, at fair market value or fair value for book purposes. And so if you turn around and sell it, you know, your basis should be relatively close to the amount that you're now receiving for it, for that particular component of this. To where it wouldn't really result in you recognizing any gain or loss on the sale of the excess, you know, or strip coupon component. But if for some reason there is a slight disconnect there, you would also get ordinary income treatment on this component. And then the final component where you can really, you know, the tax savings can come into play, although not necessarily in this scenario, is the goodwill component. So again, there are companies out there that can value these and give you some guidance around, you know, how they went about valuing each of these components. And so you get to this goodwill component, and this is where you can get capital gain treatment. And so if you think about it, right, if I just had normal servicing on an asset, and so I have no tax basis in it, and then I turn around and I sell this for $100, and I'm going to recognize a gain of $100. But I have to bifurcate that $100 into 3 components. And let's say that, you know, the compensatory portion, I have assigned a value of $10 to that. I don't have a strip coupon component because I said it's normal servicing. Then my other $90 would be considered goodwill. And if I can get capital gain treatment on that $90, then there's potentially some tax savings. Now, if I hold this for less than 12 months, I get what's called short-term capital gain treatment. Short-term capital gains do not get any preferential treatment from a tax perspective. So they don't get a preferential rate like long-term capital gain does. And so I'm still paying tax at the ordinary income tax rates. Where this could potentially provide some benefit is if you also have other capital losses that you're reporting for on your personal return. I can use short-term capital gains to offset capital losses. So if I've got other capital losses from other investments or other things like that, I could potentially still get some benefit from recognizing short-term capital gain. But I'd much rather have long-term capital gain, which is what we're going to get to on our next slide.
Yeah, let's just go to the next slide, and Jared, you could just highlight, and really all I'm going to say is now you've retained the servicing for longer than a year. So let's just talk about the differences here.
Right, so same scenario as the previous slide, but we've now held this MSR for more than 12 months, right? So same kind of process, you got to go through, you got to bifurcate the value and do the 3 components. So if we think about my example, right, I got $100 that I'm going to recognize, 10 of it's going to be the compensatory, value assigned to this MSR. The other 90 is going to be goodwill. But now, since I've held this MSR for more than 12 months, I get what we call long-term capital gain treatment. Long-term capital gains treatment, or long-term capital gains for tax purposes, have a preferential tax rate. That rate generally for most taxpayers is 20%. If you're in some of the lower tax brackets, it could be 0% or 10%. But for most taxpayers, we would say it's 20%, right? So if you're in the highest marginal tax rate, which is currently 37% for federal income tax purposes, and now on a bulk or a very large percentage potentially of my bulk MSR sale, I can now pay tax at only 20%. We're talking about a 17% tax savings. And on $100, that may not seem a lot, but on $100 million, that's a lot of pizzas, as they say, right? So, so that's that's the benefit of, and one of the strategies that a lot of our clients will engage, right, is, hey, I'm going to retain these servicing rights. I'm going to hold them for at least 12 months, knowing that on a big chunk of that bulk sale down the road, I'm going to have a 17% savings from a tax perspective.
And I just want to draw out one thing here. For a corporation, right? For a C corp, this doesn't exist. So for banks, it's all ordinary income, typically, because they're C corps. But it's the S corps or pass-through entities, again, where you get this preferential tax treatment.
Yeah, that's a good point, Seth. Yes, for C corporations, the concept of capital gains still exists. There's just no preferential rate assigned to it, right, or associated with it. And right
it's
now,
all ordinary income. I just get taxed on it.
Right. And right now, C corps, the C corp tax rate is only 21%. So you're fairly close to what you're getting, on an individual return with respect to these. But there's all sorts of other tax, nuance with respect to C corporations that's sort of above and beyond what we want to talk about today.
Yep.
But yeah, certainly a good point to point out that, the benefits we're talking about here are really going to be associated with those flow-through entities, S corporations or partnerships.
All right, we only got 4 more of these, so hang in with us because Kenny's going to get to the exciting stuff at the end. So here is the scenario that some folks have done, and this has been a very popular trade in 2023, where you created the MBS security, you retained more than 25 basis points, and you physically went to Fannie and Freddie, got their permission to create a certificated IO. So I'm just going to throw out some fake numbers here, Kenny, but I created the MBS with 40 basis points. We told you what the tax treatment is on that. You got 15 basis points of excess, 25 basis points of normal. You strip it down to 25, create true certificated IO, and literally change the servicing contract. So, Jared, what does that mean for you for tax purposes?
Right, and the distinction here and between the scenario we're going to present in our next slide, right, is the fact that you have gone through that process of actually creating a separate MSR asset, right, for the excess component here. And so from a book perspective, you are going to get sale treatment in this scenario, right, because now I've got 2 legally created separate assets that I can do whatever I want with, right? Or, I mean, to some degree at least. And so if I'm going to sell that excess piece off, I can get sale treatment for book purposes. I can also get sale treatment for tax purposes. So when I, sell that excess component, to the extent that I've recorded excess servicing for tax purposes and have bases associated with it, then I'm just going to recognize gain or loss for the difference between whatever I sell that for and whatever my basis in that asset is. And again, if I'm marking this to fair value, those in theory at least should be relatively close, and I shouldn't have much gain or loss. But various scenarios could exist here. But the key thing right here is that I'm getting sale treatment for both book and tax purposes.
And the gap side, you're getting that capital relief from either Basel III or the Ginnie Mae risk-based capital rules. So there's a lot of those trades going on. If we go to the next slide, this is the scenario where we're monetizing a portion of those servicing cash flows, but we're not changing the servicing contract. We're not going to Fannie and Freddie and creating true certificate IL. I've entered in a contractual arrangement where I'm going to offload 15, 20, 30, whatever basis points of servicing strip. But from a gap side, I'm typically not getting sale accounting. What's the tax treatment here, Jared?
Right. So yeah, GAAP treats this as a financing transaction, right? They put a liability on your books and they don't take the MSR value off, right? So the MSR stays on as an asset and they just record an offsetting liability for the portion that they quote unquote sold, right? But from a tax perspective, we sort of view it differently. I believe the book guidance says that you can't really separate this asset under this scenario at least, right? And so that's why they treat it as a financing transaction and not as a sale. From a tax perspective though, the determination of whether or not you get sale treatment is really based on whether or not the benefits and burdens of ownership have shifted. And so when you look at least most of the contracts that we've seen under this scenario, it seems pretty clear that the benefits and burdens of ownership are shifting in these transactions. And so as a result, we get sale treatment for tax purposes. And so this creates some fun book tax differences that we get to track and maintain until something else happens with this asset. But again, it's going to go on as a liability on books. We're going to get, we're going to treat it as a sale, therefore recognize gain or loss on the sale of that asset. And again, making that distinction about what book looks towards and what tax looks for. Again, tax looking at did the benefits and burdens of ownership shift. Now, could the contract potentially be written where the benefits and burdens of ownership did not shift? Yeah, I think it's possible, but probably not likely in most scenarios.
And if you're going to enter one of these contracts, I strongly advise you not only get your legal opinion, get your GAAP opinion, and get your tax opinion up front, because as Jared said, the contract is very specific. Okay, we've got two more scenarios, and then we'll get Kenny on. These two we could probably rip through pretty quickly. This is the Ginnie Mae early buyout, right? I've got that 90-day delinquent loan. I have an MSR. It's probably a liability. I buy the loan out of the pool, so I no longer have an MSR asset. So, Jared, what happens to me on the tax side?
Yeah, so with the MSR going away, we would just write that off as worthless, right? Like there's no value to it anymore. I can't really have a contract with myself to strip off a piece of my interest or anything like that. So we would write that off. Loan would get recorded on my books, most likely at fair market value, because I'm assuming the intention is not to hold this long term as a portfolio loan. But if that was the intention, if I bought it out thinking, hey, I'm going to hold this to maturity or at least for several years or something, could go on at cost, could be identified as held for investment.
And I think the last scenario that we've got, and this is the lucky 13 one, is you got repurchase loans. And we've done a whole separate webinar on repurchase loans last year. But this is, again, you got a repurchase request. So I sold the loan. Now the loan has to come back to me. Jared, now I got a loan. So it sounds like probably the same thing on the EBO rules.
Yep. Yeah, same kind of scenario, right? I got a loan now. I can't have a contract with myself to service that loan. So MSR goes away, gets written off, put the loans on at either fair market value or cost, depending on if I'm going to hold it for some extended period of time or if I'm just trying to, renegotiate it in some way or flip it or whatever, sell it as quickly as I can.
So those are the lucky 13 scenarios that we came up with. I know that some of them seem like they had a lot of distinction between them, but we wanted to kind of grind you through the details because we do get these questions quite frequently. Before we turn it over to Kenny, I've got one more poll question. And remember, you've got to answer all 4 of these. And so what statement, select a statement that best describes your servicing strategy for 2022. We plan to sell via the co-issue market, plan to sell via the bulk market, plan to sell via the co-issue and the bulk market. We don't plan to sell servicing via either of these markets, in which case we just ground you through and you're not going to win the t-shirt because you're not going to do all 13 of these different strategies. But again, you need to answer all 3 of these all 4 of these questions to earn your CPE credits. And so once we get critical mass, we'll publish the results, and then we'll turn it over to Kenny to walk us through some more of the tax strategy deep planning for 2024. How are we doing, Felicia?
Okay. Yeah, it looks like we need some more folks to come in, because I can tell that people that responded on the first 2 are not responding to this one. So again, I want to keep it open for about 10 more seconds. Make sure you get that answer in there so we can give you CPE credit.
We probably have people checking their contracts now to see if they're going to get GAAP and tax sale accounting on their non-certificated IO transactions on the call, trying to figure out what that looks like.
Okay, well, I'm going to go ahead and close it and share the results.
And again, we've got a nice even distribution, right? Co-issue bulk, doing both, and then don't plan on selling servicing. And again, I just caution folks, if you're going to sell servicing, remember, while the market may or may not be there for you, you ought to plan for at least a 60 to 90-day window to get cash and to get treatment on the sale. So again, if you're going to do a sale in 2024 as part of your strategy, just make sure you give yourself adequate time and you get it in the quarter you want. All right, that's enough of me and Jared. We're going to turn it over to Kenny now, who's going to walk you through some more details.
Thanks, Seth. Thanks, Jared. Certainly thought that was great. So appreciate you guys going over all that stuff and those different scenarios. So as Seth mentioned, I'm going to cover some tax planning stuff. My goal here is to kind of make you aware of some different tax planning items to keep in mind for 2024. Also note, a lot of this is going to be applicable to 2023 because as of now, this is the first year in a long time we haven't had a lot of tax legislation. So first item I'm going to talk about is excess business losses. And this is really going to apply at the individual level. And it relates to the deductibility of ordinary losses from a pass-through entity, your S corps, your partnerships, things like that. So these losses are limited to a certain amount in 2024. Those limits are $305,000 for a single taxpayer, and if you are married filing joint, it would be $610,000. These amounts are adjusted yearly for inflation, so we'll have another adjustment in 2025, and those amounts will change, but we have seen them go up year over year. One thing to note here is these losses that are limited, they convert to an NOL and they're carried forward indefinitely. So you don't lose them if you can't use them in the current year. You will get that benefit eventually, but they do convert to an NOL and are carried forward. And then one thing I also want to mention is you're working through the calculation to determine if a loss is potentially limited. Capital gains from the trade or business are included in that calculation. So a lot of what we've seen over the past couple of years would be ordinary losses for our flow-through entities, and then they may have a big capital gain that throws them into an overall taxable income position. So when you have that, you can include your capital gain from the trade or business when you're calculating the potential to limit the deductibility of these losses. In that situation, certainly use a little bit of bang for your buck if you've got long-term capital gain, but you still do get the benefit of recognizing that loss in the current year to the extent possible. Next, we're going to talk about net operating losses. So previous rules allowed you to carry these back and then carry them forward for up to 20 years at the federal level. That carryback has been eliminated, but you can also carry them forward indefinitely so they won't expire. One thing to mention here is under these new rules, the NOL deduction is limited to only offsetting up to 80% of your taxable income. Any amount you don't use remains to be carried forward into future years. So again, simple example, let's say you had a $10 million NOL and in the following year you made $10 million of income. you'd be able to use 8 million of that NOL. You'd be left paying tax on 2 million, and the remaining 2 million of your NOL would be carried forward. One other thing I want to mention here is at the state level, the NOL treatment's determined on a state-by-state basis. So there's a lot of states that decouple from these federal law changes. Some will let you still carry them back. Some won't have the 80% limitation. So it is important to analyze those on a state-by-state basis, understand those rules, and make sure you're applying appropriately as you are able to claim those NOL deductions. So next thing we're going to talk about is specified research expenditures, commonly referred to as 174 amortization or these new 174 rules. This actually came out of the Tax Cuts and Jobs Act, which was passed in 2018, but it did not become effective until tax years beginning on or after 1/1 of 2022. Previously, these expenses were deductible under Rev Proc 2000-50. And a lot of IMBs are saying, well, wait a minute, I don't have any specified research expenditures. These do capture software development. So servicing software, loan origination or approval software, any internal automation, improving your processes. These are all going to be captured under this new 174 law that went into effect at the beginning of 2022 or with 2022 tax years. So under this new law, how are we going to treat them? We're going to amortize them using the straight line method with a half-year convention. That half-year convention is important because in that first year, for domestic SREs, for example, when you're using a 5-year amortization period, you'd think, okay, well, I'm going to get 20% each year. But you really get 10% in year 1 and 10% in year 6. So it's really going to take you 6 full years to realize the deduction related to these costs incurred. So domestic SREs, again, that's a 5-year amortization period. Any foreign specified research expenditures have a 15-year amortization period. One thing to note is if you dispose of the asset itself or whatever project you were working on, you're not allowed to write off the remaining basis. You have to continue to amortize these over the remaining period. One thing that can help would be the R&D credit, and that can help offset, that adverse impact of having the new amortization requirement. Previously, a lot of taxpayers would claim what's called make a 280C election, which allows you to claim what's called a reduced credit. The way the rules work now, the gross credit becomes more beneficial because if your add back related to amortization is more than the credit itself, you actually don't have an add back for the credit. As this relates to NOL, one thing to mention here is these are considered general business credits for the R&D. So you do still have the ability to carry that back 1 year. If you can't use it, you can carry it forward. Do want to mention that though. And again, it is a great way to help offset the amortization requirement. The way that works quickly is everything that qualifies for an R&D credit is going to be captured under that 174 umbrella. However, not everything that is considered a 174 expense is eligible for the R&D credit. So if you're having to capitalize some of these expenses, there's a chance that you have a credit there that you could benefit from. And again, for these as well, state conformity varies by state. And that's important because if you were required to add back these expenses at the federal level and amortize them, some states that don't require that amortization approach would require you to take that full expense in that first year when the expense was actually incurred. You want to make sure you do that because if you continue to amortize them, those returns were audited, you weren't entitled to the expense, they could be disallowed, and the year you should have taken them could have been closed. Next, we've got bonus depreciation. So Tax Cuts and Jobs Act gave us 100% bonus depreciation for assets placed in service between 9/27/17 and 12/31/2022. That begins to phase out. So in 2023, we had 80% bonus eligibility or write-off. For 2024, it'll be 60%. And as you'll see on the slide, it will continue to phase out until 2027 when we get to no bonus depreciation allowed. Next, we've got entertainment and business meals. So Tax Cuts and Jobs Act again amended 274 to disallow entertainment expenses. It does allow a 50% deduction for business meals at entertainment events, but you want to make sure when you get a receipt, you get that itemized and it breaks out the cost of the meals versus the cost of entertainment in order to benefit from the fact that you could get 50% deduction on some of those expenses. Business meals in 2021 and 2022, as long as they were from a restaurant, were 100% deductible, and that happened through the Taxpayer Certainty and Disaster Relief Act of 2020. In 2023 and future years, again, business meals are going to revert back to that 50% deduction. So just make sure you're accounting for that as you plan for your taxes. Another thing we wanted to talk about was the pass-through entity taxes, or PTE taxes as they're commonly referred to. A lot of you guys should probably be familiar with these for your flow-throughs, but really what it did was allow states to have a workaround for the $10,000 state and local tax deduction cap that would be normally claimed on Schedule A when you would deduct your state taxes. This basically allows the entity to pay the tax for you and flows the deduction into the ordinary income or loss that you're receiving from the entity on your K1. So it bypasses Schedule A and allows us to circumvent that $10,000 cap. Currently, we've got about 35 states that have PTE elections available. Keep in mind, this is an entity level election, so the entity is going to make that election. You can make it as an individual if you had a disregarded entity, Schedule C, things like that. But for most of you guys, it's going to be an entity level election. The guidelines for each election vary by state. It dictates who can be included in a PT election. Sometimes they restrict it to individuals, sometimes they'll allow everyone. It also dictates the election timing. Some require it to be made before the end of the tax year, some by the extension time, or some just by the time you file the return and you make it on the return. Allows you to include the entire net income of your residents in the state, potentially. And then also the other big thing is that it's, some of them will satisfy the non-resident filing requirement and some will not. We always want to incorporate that into our analysis because the last thing we want to do is significantly increase the complexity for the individual owner and weigh that with the potential benefit of making the election. We do want to make sure that we're evaluating these elections on a state-by-state basis and taxpayer-by-taxpayer basis when deciding if we're going to make an election. One thing I had here, some states have a capital gain exclusion. So if you had an MSR sale, we may want to not make a PT election because we want to take advantage of the ability to exclude a portion of your capital gains at the individual level. All these are items that go into the decision on whether to make an election or not. Next, we've got important changes for 2025 and beyond. So these are all expiring provisions. Currently, there's an increase to the AMT exemption that will expire in 2025. Same with the QBI deduction under 199 Cap A. 2025, our excess business losses or the limitation of losses for non-corporate taxpayers, that was extended out to 2028. Before that will expire, cap on state and local taxes 2025, limitation on mortgage interest deduction 2025, changes to the charitable contribution deductions will expire in 2025. And then in 2025, our rates will revert back to the pre-TCJA rates. So as Jared mentioned earlier, 37% is currently the highest tax rate. That'll revert back to 39.6%. Last thing I want to tell you is that everything I just told you, or not everything, but a good chunk of it could change because there was a bill that made it through the House Ways and Means Committee with a vote of 40-3 being approved. This is for the Tax Relief for American Families and Workers Act of 2024. When you see a 40-3 vote, that means it's a pretty bipartisan bill, but that doesn't mean it's going to become law, because if in the House or the Senate, one party or the other decides they absolutely have to have something in it, and the other party does not agree or not willing to go for that, they're not going to pass the bill. But as it looks right now, there is a good chance that this bill could pass. It's supposed to go to the House floor this week. Senate floor probably would be next week, would be my guess, if they have time to fit it in their schedule. And so we'd probably see it become law sometime in February. They're going to pay for this with increased enforcement related to the employee retention credit. And the main provisions here would be the 174 would get delayed until 2026. They are going to give us a fix for any 174s that we have already capitalized in 2022 on our tax returns. It will also restore depreciation, amortization, depletion when you're calculating your adjusted taxable income as part of the business interest expense limitation, which will benefit, especially in years that we may have small losses, things like that. And it would restore 100% bonus through 2025 and increase the 179 limit. Please note, it would drop down to whatever the current limits or phase outs would be in that year. I doubt we'll ever get to that percent. I don't think we've ever been below 30%, and when it reverts back, it would go to 20, so there would probably be a fix before then. Then the last thing, a little bit non-income tax related, but probably will help some of you guys, is an increased threshold for the need to file your 1099s from $600 to $1,000 for payments made after 12/31/23. So with that, I think we're going to roll into our last poll question. And that poll question will be, which potential legislative change will benefit your company the most? Would it be the deferral of the 174 expense capitalization requirement, restoration of bonus, restoration of depreciation, amortization, and depreciation when calculating ATI under 163J? And the last one would be just the increase in the threshold for 1099 reporting. So give you guys a little bit of time.
And again, this is our last poll question, so I want to make sure that you get that CPE if that's what you're here for today.
Absolutely.
Okay, it looks like I have just about everyone in, Kenny. I'm going to go ahead, close this and share it.
All right. And Felicia, I might have you go ahead and share those results if you don't mind for me. I can't see them on my screen.
I can chime in here too. Yeah, pretty good disbursement here. Looks like the winner is the 100% bonus limitation. That does benefit a lot of our clients, you know, basically being able to fully write off your fixed asset purchases. And so, yeah, it's, you know, hopefully we'll see some results on this bill here in the next couple of weeks, as Kenny said. And if it becomes law, I think there's some good provisions in here that could benefit a lot of our clients.
Perfect. Thanks, Jared. I appreciate that. So from here, Seth, I think I'm going to turn it over to you to handle the Q&A and any closing comments you might have.
Yep, and we've got one question which we may get to, but I just wanted to alert everybody, the Fed did make unchanged on rates today, but Chairman Powell said it's too early to declare victory, and he is not necessarily committed to a rate cut in Q1. The next meeting, I think, is March. I know the market was trying to get him to say something about a March rate cut. I think they're a little bit too early on the data side to declare victory on inflation. We'll see how the market reacts to that. I do think rates will come down this year, but I just think March Q1 is probably not going to happen. But we'll see. He's doing a press conference right now. Jared, real quick, I think we got two quick questions in. One was just a little clarity on safe harbor numbers, kind of around Ginnie Mae 2s servicing, where you could have that 19 to 69 strip. So has the IRS ever kind of like considered like changing safe harbor, or is it we're pretty safe at 44 even though we have the Ginnie Mae 2 securities at this point?
Yeah, I mean, I haven't seen or heard anything that seems to indicate they're looking into or considering a change to those safe harbor rates. It is interesting because those safe harbor rates date back to the early 90s, right? So obviously it was a lot more expensive to service a loan in 1991 than it is here in 2024. But they're still there. So as long as you know, they're there, there is some tax benefit in being able to utilize those higher rates for that and you know, consider that normal servicing.
Great. Well, we appreciate, we've run everybody up to the top of the hour here. So Jared, thanks for answering that question. We appreciate everyone's time today. It's great to do a presentation with the tax team. As you can tell, tax is always changing. Stay tuned to what's going on in Congress. And if you need assistance, you could contemplate any MSR transactions or anything that Kenny talked about, please reach out to your Richard May representative here. I can help on the strategy side. Obviously, we've got the tax experts here. We want to make sure that you stay compliant with the tax laws. stay out of trouble. And again, thank you for your participation. Thanks for being a Richie May customer. And we look forward to helping you through your strategies in not only 2024, but 2025 and beyond. So have a great afternoon. Thanks, everybody.
Thank you. Take care.
Guys.
And there's a survey here at the end. Please fill it out. Felicia, I think you